Alrighty, guys. I feel like I'm always apologizing to you for how long it takes me to get the videos out, but I do like them to be perfect and I like to bring as much value as I can. So, truthfully, I had filmed the second part to the vocab video and I didn't like it. I was a little bit rusty. I filmed it recently. I was a little bit rusty and I wasn't able to go as deep on some of my explanations as I like to be able to for you. And I feel like that's why you guys come here, is to get a deeper understanding of these terms. And I didn't want to put something out that I felt like was not my best and was not going to be the thing that helped y'all the most. So I went through, I made a little cheat sheet. I did a little bit of research. That way I would be able to do that for you guys, because I want to, like I said, bring as much value as I can. And I want my channel to be like a one-stop shop for y'all to come here to learn everything that you need to pass the first time. And I'm so incredibly happy to say that a lot of the comments, people will come and leave that they have passed their exam the first time. So that makes me very happy. And I hope that if it's your first time watching this, you pass the first time too. But if it is your first time watching this, please don't start here. This is part 2 to my vocab series. The vocab videos there's only 2 of them. When I filmed it originally, it was like 1 hour and 23 minutes. I'm assuming that this one's going to be somewhere around there. So get cozy, buckle up. You're in for a treat, I hope. I think this one's going to go a little bit better the second time around than the first time. So yeah, without further ado, I'm going to share my screen and get right into it for you guys. All right, so Quizlet is doing this thing now where it has ads. So I will probably be pausing the recording as we go through. That way we don't like waste time just sitting here staring at each other, right? As we like wait for these ads to go. So we had 144 terms to get through. In video number 1, we got through 72 of them. So this is where we left off. Factors that impact premium amounts. There's 5 types: age, gender, health, occupation, and hobbies. So we are moving on to number 73, premium mode. Premium mode is the manner or frequency that the policy owner pays the premium. The higher the frequency of payments, the higher the premium. So the best way for me to explain that little asterisk to y'all is it's like Costco, right? We know if we go to Walmart or Target and we buy toilet paper and there's 12 rolls, it's going to be more expensive per roll than if you go to Costco and buy, 48 rolls at a time, because you're buying in bulk. They're wholesaling to you, right? So it's the same with insurance. If you choose, and I think the modes are up next, or the frequencies are up next. If you choose to pay your premium in one payment, in an annual payment, then you're paying less. If you were to take that annual premium amount and divide it by 12, you'll realize that that payment, that monthly number, would be less than if you chose the monthly amount. So they're charging you just a little bit more for the convenience of paying monthly, right? So that's exactly how it works. It's like Costco. Premium modes, 4 types: monthly, annually, semi-annually, and quarterly. So monthly, you're making 12 payments a year. Annually, you're making 1 payment a year. Semi-annually, you're making 2 payments a year. And quarterly, you are making 4 payments a year. Death benefit payment options. So this is, if you are the beneficiary, these 5 options are how you can choose to take the death benefit. You can choose a lump sum. So let's say my parents pass away, they have a $500,000 policy. If I'm the sole beneficiary, I can take $500,000. Interest only. So the insurer or the insurance company has to pay you interest on any money that is essentially sitting in your account with the insurer. So they have to pay out the death benefit funds within a 30-day time period. Anything past that 30 days will start to accrue interest. So you can choose as a beneficiary to only take the interest payments, and you can leave the principal with the insurance company. And then your beneficiary, that secondary beneficiary after you pass away, can get the principal amount if you just lived on the interest only. Fixed period, of course, if you leave the money with the insurer, they'll distribute that money to you in equal amounts over time. So fixed period would be, I can say, it'd be great to have $500,000 all at one time, but it would also be great if I could get $500,000 paid out to me over the next 30 years, almost like an annuity, right? So the company keeps the money in an account for you, and then they'll pay you out, monthly or annually for 30 years, if that's the option that you choose. Fixed amount, it's a set unchangeable amount, and the payout is constant, meaning even if you pass away, if there's still money left over, that money will go to your beneficiary until you've exhausted all the funds. And then life income, you can say, I want to make sure I have an income for life, essentially like an annuity, and the company will choose what your payout amount is based on your age and your gender. So a bunch of different options for how you as a beneficiary can choose to receive your death benefit funds. I'm going to pause really fast because my laptop is about to die. Okay, there we go. Viatical settlement. This is also referred to as a life settlement. So life settlement or viatical settlement. It's the sale of a life insurance policy by a terminally ill insured to a third party, typically to investors or investor groups who hope to profit by the insured's early death. Okay, that sounds bananas, right? So I'm going to go ahead and do a new share, and I'm going to whiteboard draw this one out for y'all, like I like to do. Okay, so in a viatical or life settlement, a terminally ill insured, let's say we have Bob, and Bob is 70 now. Bob has a permanent life insurance policy. Let's say his death benefit's $500,000, right? So he gets diagnosed with cancer. The doctors say that it's terminal. If they can treat, maybe he'll live. If not, about 6 months to live, right? So that's our story. We've got Bob. So Bob says, well, I have this, $500,000. Like, I don't have any money for treatment, but if I pass away, my family gets this money. What can I do? So Bob goes to a viatical settlement company and says, can I get money for treatment? I have this life insurance policy that's worth $500,000. And they say, this is what we can do for you. You have $500,000 that will be paid out to your family upon your death, right? We will give you $350,000 while you're still alive. And maybe you'll be able to use that money to go and get treatment, and maybe you'll be able to live longer, who knows? But because they gave him that $350,000, they're buying being his beneficiary now. So instead of his family members or whomever was his beneficiary, that company that paid him that $350,000 is now his beneficiary. So when he ends up passing away, they make the profit on that leftover $150K. I hope that was pretty simple and made sense to everybody. So that's how that works. That's how those companies are able to profit, and that's how people are able to hopefully get some money to get the treatment that they need or live like they were dying. Who knows? Tax treatment of benefit proceeds. Okay, policy premiums. When you, as the insured, it has a life insurance policy, pay your policy premiums, they're not tax deductible. So you cannot go to the government and say, hey, government, I'm actually using my money that I made from my job or my business to pay this life insurance policy. Can I deduct that off of what I owe you in taxes? No, you cannot do that. You are choosing to have a private life insurance policy that you pay for with your after-tax dollars. So the premiums, not tax deductible. Lump sum death benefit. So when you get your death benefit, if you take it all at once, it's income tax free. little hairy, like if you choose to leave it over time and there's interest accruing, obviously on that interest, you'll pay income taxes. On the principal, you won't. So that's why it says lump sum death benefits tax-free. It's income tax-free. It is not estate tax-free. I think I went through that in one of my past videos because you don't necessarily need to be concerned about yours or your client's estate tax problem if they are not a high net worth individual. Currently our personal exemptions are 13 million each, almost 12.9. So for a couple, your exemption total is about 26 million right now. It's going to go down in 2026 to about 7 million per taxpayer. So that family that has a 26 million exemption right now is only going to have a 14 million exemption come 26. So if you're dealing in the realm of high net worth and you come across a family with more than $14 million in net worth, this is where you have to be a little bit careful, because you will start to cause an estate tax problem for them if you get them these life insurance policies. So just something to be aware if you're in that high net worth region. But when you get up there, you should typically have like a mentor or somebody that's done this before. That's where I work with attorneys, and they'll help do like life insurance trusts and things like that. So that's little tangent. I hope, like I always say, that my tangents are helpful for you guys. I just, with all this information in my noggin, I want to make sure that you guys are as educated as possible when you go out into the world and present yourself as a professional in front of your clients. Death benefit installments, principal is tax-free, interest is taxable. There we go. I didn't even read ahead. I'm just psychic. I knew. There we go. All right, 1035 exchange. I came from the real estate world, still in the real estate world. And if you know anything about real estate, you know about the 1031 exchange, where you can defer taxes by not selling a property, but turning around and taking the profit that you would have to pay cap gains on and just reinvesting it into new property. Kind of like that. This is the 1035 exchange, which is your life insurance tax code. And it just states that an existing life insurance policy can be assigned to another insurer for a new contract. You can essentially just do the same thing, roll your current policy into a new policy with a different company. Postpones tax consequences. So with that roll, there won't be any tax burden to you. I guess like an example of why a client would want to do that. We've done 1035 exchanges in the past with clients that have permanent life insurance policies that have that cash value, but they don't have living benefits. I have told my story briefly in one of my videos. I don't know which one. I got into insurance because of living benefits and because I did not have them when I needed them. And so we've talked about it before. If you're doing a policy replacement or like a 1035 exchange, there has to be a benefit to the client. So in this case, when we've had clients do 1035 exchanges in the past, it's because their current policy did not have living benefits, and we've rolled them into new policies that are same thing, cash value, permanent life insurance, but do have living benefits. So that's a little, I guess, real life example for you guys of why a client would want to do a 1035 exchange. Okay, beneficiaries in order of succession. This one's pretty simple. Primary, secondary, tertiary. When you are sitting with a client and you're putting in their life insurance policy application, obviously they're going to ask, who do you want the money to go to? So when you ask the client this, there's always a primary beneficiary and there's typically a secondary beneficiary. Only one of the companies that I'm contracted with have I ever seen a tertiary be an option, but I think you could always reach out to the company and say, hey, you know, they want to add a tertiary beneficiary on there just in case the primary and secondary pass away at the same time or just pass away before me. Primary is the first person that your money will go to, and you can choose, you know, 100% to this person, 50% to this person, 50% to that person. You can break it up basically however you want. And then secondary, it's not, this is not, it goes to this person and this person, primary, secondary. It is the primary gets everything And if the primary passes away, if it's 3 people, if it's 2 people, if all of the primary passes away before the secondary, then the secondary gets it. And if all primaries and all secondaries pass away before tertiary, then tertiary gets it. First, second, third. I hope that was clear. A revocable beneficiary, the policy holder reserves the right to change the beneficiary designation without the beneficiary's consent. So sometimes clients will ask you that. I have to put in a policy this weekend for a woman who, when she and her fiance came to us, they were not married yet. So they did not put each other down as their beneficiaries because they weren't married yet. I think they put their parents, and then they asked, can we change it later? In that situation, you would want to make sure that you do not have a revocable beneficiary option selected, because they want to be able to go in and just easily make the change. It's not impossible with a irrevocable beneficiary to make the change. The beneficiary just has to approve it. One that cannot be changed without the beneficiary's consent. So if you have a revocable beneficiary, you can change it at any time without having to get written consent by your beneficiaries. And if it's irrevocable, you must get consent of the beneficiaries before you can make the change. Underwriting, again, this one's pretty simple. This is just the process of reviewing the characteristics that make up the risk profile of an applicant to determine insurability. So as you are sitting with your clients and you go through and you're putting in applications, there's all the medical questions, right? Do you have diabetes? Have you ever been in, I don't know, a crazy accident? Like all this stuff, there's surgeries and this and that. All those questions that your clients will answer make up their risk profile. And when a company goes through and underwrites your client to see A, if they are insurable, and B, what their risk class is, that's the process of underwriting that client. Okay, so in order to purchase a life insurance policy on anyone, there has to be an insurable interest. So these are all the types, these are the ways that insurable interest exists for somebody to buy a life insurance policy on someone. So you have unlimited insurable interest in yourself. So I can buy as many life insurance policies on myself as I am able to qualify for. Husband and wife can insure spouse. Parents can insure their children. Children can insure their parents. Businesses can insure their key employees. Business partners can insure each other. And a creditor can insure a debtor for the term and the amount of the debt. Pretty self-explanatory. Yourself, obviously, spouses, once you're married and you become one, if one passes away, you're basically responsible financially for the funeral costs and life without that person's income. So you have unlimited insurable interest in your spouses, as long as you're married. Parents can insure children, of course, because they bear the financial burden of bearing their children. And then children can insure parents because typically a lot of time, well, unless the parents have a spouse, the children will also potentially be financially responsible for bearing the parents. Businesses can insure their key employees because, of course, if you have somebody like your CEO, your CFO, your COO, whatever down the line, if that person passes away, there's a lot of intellectual property there. So there's going to be a hit to the business while you have to sort everything out and figure out everything that person knew and was doing and finish their projects. But you also have to take the time to go out and hire somebody new and then train that person. So it's a way for the business to have money there to go and pay the salary of the new person if there's a difference in market demand, a way for the business to have money to maintain day-to-day operations while they're going through the transition of not having that person there anymore. So it's super beneficial for businesses to insure their key employees. Business partners can insure each other. We'll go a little bit deeper into what that's called later. But of course, if I go into business with my brother and then I pass away or my brother passes away, we want to ensure that the business can continue. And, if it's a $5 to $10 million business, each of our halves are worth $2.5 to $5 million. We want to make sure that we have the capability of buying out that other person's share, and that somebody doesn't just come along, buy it out, and now they have a controlling interest in our business and they are able to vote and make decisions on my business and my brother's business that maybe we wouldn't do or we don't agree with. So we want to make sure that we can continue our business. And then, of course, creditors can insure debtors for the term of the debt. And of course, the amount of the debt, pretty self-explanatory. If you owe somebody money, they want to ensure that they're paid back. They can go and take out a life insurance policy on you to ensure that if they do pass away, they're made whole. All right, the Medical Information Bureau, or the MIB, I always lovingly call them tattletales, right? I tell you guys, just make sure your clients are as transparent as possible with you, because if there's something in their medical history, the MIB probably knows about it. And if they don't disclose it, so it doesn't go on their application, you're going to hear about it from the underwriters. Yeah, all I can say about that. An information database that stores the health histories of individuals who have applied for insurance in the past. I talked about it a little bit when I filmed this video the first time. It's really, really cool that with technology and innovation, there are some companies, like we work with National Life Group, that have the technology for you to go in and essentially pre-try your client to see what their rate class would be. So if my brother and I have put in so many policies that have been declined for health histories that we didn't know about, or things that the clients forgot about, or things that were buried deep in attending physician statements. And even we put in policies that, like, we know, okay, maybe that's a little iffy, but maybe they're young enough, maybe they're this enough, maybe it's been long enough, but we weren't sure. Now there are tools with some of these companies that you can go in and you can put in the client's, age and answer a ton of their health, profile questions. And you can put in, like, hey, they have this condition, and see what the company is likely to rate. So then you don't necessarily, like, if they come back and say they're going to decline, then you don't have to put in that application. It saves you the trouble of going through the work to do it and then come back decline. And that affects your placement rating, right? And it saves the client, because if you see here, information database that stores health histories of individuals that have applied for insurance in the past, you're hitting that client is getting hit on, now I've been declined for a life insurance policy, and that's in my record. So if I try again, it's going to be flagged. They're going to know, hey, I was already declined by somebody, and they're going to look into me a lot deeper. So pretty cool that there are some tools that are, coming out now, and the technology is evolving to help avoid that. Warranties are statements in the application that are guaranteed true in all respects. Guaranteed true. I am Sarah. I am 29. I was born January 21st. This is my birthplace. I don't have diabetes. I have asthma. These are things that are guaranteed true. Representations are true to the best of your knowledge. So it's not like you're going to be going through this application and you have to pick, like, this is a warranty, this is a representation. It's just kind of a classification of these answers. It's never something you're like, oh, I have to pick which one is which, but you do have to know it, especially to pass your exam. Oh, this one's short, so we'll just leave it. What did I do? Click on it. Don't click on it. Skip that. Okay, sorry about that. Conditional receipts indicates that certain conditions must be met in order for the insurance coverage to go into effect. There are two types, the insurability receipt or an approval receipt. So this just means It's not an automatic yes. There are conditions that must be met in order for the company to go ahead and put that policy in place. Now, the cool thing about conditional receipts are if you're in that period where it hasn't been approved yet and that client passes away, they will pay out a death benefit as if it were approved. So I think that's pretty cool. Binding receipts. This states that the effective date of the policy is the date of receipt of the initial premium. So we've talked about this before, right? Or if you're starting at Vocab, you'll see this when you go through the 8-part series. With contracts, there are contract requirements, right? And one of those requirements is the offer and acceptance of that offer. So with life insurance, you'll put in the application with the client. It's going to go through underwriting, and then you'll get an answer back, right? So with that answer back, if it's an approval and an offer saying we will offer your client $500,000 of coverage for $30 a month, that's the offer. The acceptance is when the client says, okay, and they pay their premium, that $30. That's accepting the contract as it is, right? So these binding receipts just state that that policy is effective the day the company receives that $30 premium. Should the applicant die before it is fully processed, the benefits are fully payable. So the company will pay it out whether or not they would have been approved. So same thing I just said, if you're in that limbo period, we'll call it, and that client passes away, the death benefit will pay out, whether it's conditional or binding. Policy effective date identifies when the coverage is effective, but also establishes the date by which future annual premiums must be paid. So if you choose the annual option, that's the day on which your premium is due and payable every single year. The policy will not be truly effective until it is delivered to the applicant, the first premium is paid, and a statement of continued good health is obtained. So I don't believe these good health statements are always collected. In my experience, companies will collect these good health statements where like your client will just say, nothing has changed in my health history since this was approved, and sign off on it. Usually they only ask for that if the client like waits a month or 2 or 3 before actually putting the policy into effect and paying that premium. But they like, let's say they're approved in July, but they don't pay the first premium until October. They'll have to like make that good health statement because things have obviously happened in the last 3 months. But yes, that's your policy effective date. Backdating is using premiums based on an earlier age. It makes the policy effective at an earlier date than the present. Pretty simple. Backdating makes the policy effective at an earlier date than the present. Yeah, it's not super common, but backdating out. Group insurance. Way to provide insurance coverage to a number of people under one contract. This is typically written for employee-employer groups and is most often written as an annually renewable term policy. So, like it says, this is typically, like group policies are typically found within your job, right? And so probably if you're watching this, you might have a job that has an annually renewable term policy available to you. When I've sat with people in the past, I typically find that they're about a $50,000 policy. They have to opt into it every single year. They pay like $2 for it a month. It's nothing crazy. But there's also like a lot of stipulations on what it won't pay out for. So there is a pretty big opportunity there for you if you do come across a client or you talk to your friends and they say, oh, I'm good, I'm covered through work. You are, but like you're also not. And so this is something that you want to educate yourself on so that you can sit down and talk to clients and educate them on it, right? So they have to opt into it every single year. It's typically either $50,000 or equal to their annual salary, like 1 year of their salary. And it's through their employer. So it will typically only pay out if they pass away at work or from an illness or a condition that was caused by work. So that's where your big opportunity really lies. I've told the story in some of my past videos. There was somebody in our office who came from like a company, I won't name them. I think I did the other one. And they got COVID 2020 time and passed away. And the family could not prove that COVID came from work. So the policy never paid out. So they didn't even get their $50,000 to go and pay the funeral. So that is something that you want to educate people on when people say, oh, life insurance is a scam, it doesn't pay out. Usually that's why, because they're not reading that fine print. Contributory plan. This is an employee group insurance plan in which employees share the cost. Like I said, they pay a couple dollars a month for it. A non-contributory plan is where the employer pays the entire cost of the plan. So in group insurance, there is a master policy. The master policy, I know I'm like probably really tiny right now, but hopefully you can see my hand. The master policy is issued to the employer, that's the policy holder. The individuals do not own the policy, the employer does. They're issued a certificate of coverage. So this is where I make my little octopus, right? All the little tentacles down here are all the different employees that are issued what's called a certificate of coverage. So that's how group insurance policies work. Rate classes. Okay, your 4 rate classes, and the words might differ a little bit company to company, but this is pretty standard. You got preferred, standard, substandard, and then of course declined. So preferred is you're in great health. So you're a low risk to the company, meaning your premiums will be lower. If you're standard, you're of average risk. You may have a little bit of something in your health history, but it's from a while ago. Maybe it's not a chronic illness. It's not causing you problems now, nothing like that. Average risk, standard premium across the board, right? Substandard means there's some things in your health history that the company is not super keen on. And they're like, okay, because of these things, we think you're going to be a little bit of a higher risk. You may pass away a little bit early. The cholesterol's there, whatever it might be. High risk means higher premiums. And then of course, declined is not insurable. There are a number of conditions, a number of reasons that a company might decline an applicant. And a lot of them will have like underwriting guides that can help you before you sit down with a client and they say, I have this thing. You can go onto the company's underwriting guide and say, oh, okay, you're probably going to be rated or declined. We're going to see where you fall on that spectrum, depending on the rest of your health. Very helpful. Group conversion to individual insurance. If a member's coverage is terminated, the member may convert group coverage to individual whole life coverage without having to show proof of insurability. So this is also called the conversion privilege. Conversion privilege. That just means exactly what this says. If you quit or are terminated or are laid off from your job or whatever you have group insurance through, you can convert for up to 31 days after the termination of the policy, the group policy, to individual whole life coverage, and you do not need to prove insurability. The benefit of having a group life insurance policy like through your job is that you don't have to go through medical underwriting. You don't have to answer any of those like medical questions. You just opt into it. So if you're someone who otherwise is uninsurable, you have that little glimmer of hope that you might get a payout of life insurance now, right? So the benefit, I think, really lies in the privilege part of the conversion privilege is if you are an individual that would otherwise be uninsurable with a private carrier, but you have a group policy through work and then you terminate working that policy, whatever, and you go and you can convert to a whole life individual policy that will stay with you, and you don't have to go through that medical underwriting. You don't have to prove you're insurable. So this is kind of like your little back door to getting yourself a permanent policy if you are uninsurable. That's the privilege part of the conversion privilege. The conversion period. Individual must apply for individual coverage within 31 days after the date of group coverage termination. There you go. You have 31 days to exercise that option. All right, we're going to get into annuities. The annuitant is the income recipient of an annuity. Single premium annuity. This is an annuity purchased with one lump sum payment, generally with after-tax dollars. We've had clients that had, let's say $2 million sitting in the market. And, if their $8 million portfolio, they're like, oof, the market's not doing so hot right now. I want to take this $2 million out and I want to go and put it into something a little bit safer. We can get them an annuity like this. And we did this, actually, an anecdote, not me, but somebody within my team took that $2 million, they took it out of the market, put it into an annuity. So that was a one lump sum payment of that $2 million. They were after tax, was already sitting in one of her brokerage accounts, one of her investment accounts. So that is an example of a single premium annuity. A deferred annuity provides income payments at some future date. So typically, when you do single premium annuity, you'll hear single premium immediate annuity, which just means I gave you the money one time and I want my income stream to start right away. So it will annuitize right away. Now, typically with, it's short. Typically with deferred annuities, because it's providing income payments at some future date, you will make premium payments over time. So I'll use myself as an example. I used to work at a hotel and I had opted into my 401k when I was at the hotel. So I had, after the market crashed, some money sitting in there that I wanted to roll into something a little bit safer. Started with, my insurance company back in 2020. And I was like, oh my gosh, this is perfect. I can just roll this right into, a fixed index annuity. So that's what I did. I rolled my old 401k into an annuity. So I made one lump sum payment then, but because I'm not going to start receiving payments immediately, I won't start receiving annuity payments until like 40 years from now. I can put money into that annuity over time and it will continue to grow and it will continue to gain interest. And then there's more for me later on in 40 years when I do start to annuitize that annuity. So deferred annuity has an accumulation period. You can keep putting money into it and then it pays those payments out at some future date. Periodic payments, premiums are paid in installments over a period of time. There you go. That's exactly what I just explained. Immediate annuities, designed to make its first benefit payment to the annuitant at one payment interval from the date of purchase. You can start taking money out after 1 month. These are funded with one single payment and are often called SPIAs, or, like I just mentioned, single premium immediate annuities. Okay, your accumulation period. There are 2 time frames to an annuity. You have your accumulation period, which is this, the time before an annuitant's retirement, during which the annuitant is making payments or investments in an annuity. So currently, right now, with my anecdote, I am in the accumulation phase, right? That annuity that I have, that I put my money in, I can put money into it every single year if I want to, and I'm getting interest as the index that it's assigned to, or like tied to, there we go. The index that it's tied to goes up, I'll make interest payment, or I'll receive interest. So that's the accumulation period. And then your second is, I don't know if it's on here. I don't want to get ahead of myself, but I'll just tell you because whatever. The annuitization period. So accumulation, accumulate money, annuitization, money gets paid out. There you go. Life with period certain option. This is an annuity option that is designed to pay the annuitant an income for life, but guarantees a definite minimum period of payments. So what that means is I start taking annuity payments and there's, $1 million in there. So I'm taking payments, I'm taking payments, I'm taking payments. I'm going to have it for the rest of my life. I pass away after 5 years. There's a lot of money left in that account, right? There's a lot of money sitting there. So what this means, life with period certain, it says, okay, life and a 10-year contract. And if I die after 6 years, my beneficiary will still get paid for the remaining 4. Because a life only would stop when the life ends and there would be no residual benefit to a beneficiary. So this says life, so pay me for my life. If I live for 30 years, pay me for those 30 years. But I want a guarantee. So I'm going to have life with a 10-year period certain option. So if I pass away at year 6, for 4 years, my money is going to go to my beneficiary. And after those 4 years, all that money goes back to the insurance company. No more goes to my beneficiary. Teach their own, right? Okay. They're a little like in a weird order because I didn't put them in any order. So we might jump from topic to topic. So this is fixed annuities. Fixed annuities provide a guaranteed rate of return. When converted to payout mode, fixed annuities provide a guaranteed fixed benefit amount to the annuitant. So fixed annuities are your safe bet, right? That's going to be your most conservative client. This is what they're going to want. 4%, 4%, 4%, 4%. I'm making 4% no matter what the market does. And when I am paid everything out, I made a set amount. So now I'm going to, I made a set amount on my accumulation period. So now my annuitization period, I'm getting paid a set amount because it's predictable. It's fixed, right? Variable annuities. Variable annuities shift the investment risk from the company, the insurer, to the contract owner. Value of a variable annuity fluctuates in response to movements in the market. Thus, the amount of annuity income can fluctuate even after the contract has annuitized. So this is your riskiest client, the one that says, I know the market's, unpredictable, but we did 20% growth last year. So I want everything in a variable annuity. It's going to go up and down, right? Some years we might do 20%. Some years we might go negative 15%. So unlike fixed annuities where the payout will be pretty steady and stable and predictable, your payout is going to change because the amount in your account is going to change. Anyone that invests in the stock market, you know exactly what that's like. Sometimes when I look at my account, there's a lot of money in there. And sometimes when I look in my account, there's a lot less money in there. So I'm willing to take out less when those numbers are less than I am when those numbers are higher, right? Cash refund option provides a guaranteed income to the annuitant for life. If the annuitant dies before the annuity fund is depleted, a lump sum cash payment of the remaining balance is made to the annuitant's beneficiary. So it's pretty self-explanatory, right? Guaranteed income for life. And when the annuitant dies, if the fund is not depleted, the cash payment will go to the beneficiary. So cash refund option, unlike the one I was just talking about, where there's no residual benefit to the beneficiary and all the money goes back to the company, this is the opposite of that, right? Lump sum cash payment of remaining balance made to beneficiary. So you actually get, like, your money goes to your family. Joint and full survivor option provides income for 2 people. If one dies, the same income payments continue to the survivor for life. There's no beneficiary after the second person dies. Okay. let's say me and my husband. Say I'm married, the two of us. So it's a joint and full survivor option annuity. So it's going to provide income for the two of us. And if I pass away, the same income payment that we were getting when there was two of us will go to my husband. But when he passes away, all the money goes back to the company. There's no residual benefit to any beneficiaries after. I'm going to pause really quickly. Okay, I'm back. I had to get some water. Okay, equity indexed annuities offer the potential for higher credited rates of return, but also guarantee owner's principal interest credit. Offer potential for higher credited rates of return, but also guarantee owner's principal. The interest credited is tied to increases in a specific equity or stock index, which results in long-term inflation protection. Okay. So we talked about fixed, we talked about variable, and now this is your hybrid, right? Equity indexed annuities or fixed indexed annuities. This is like the skyscraper analogy, right? So when you're building a skyscraper, you're building, and then it rains. And then you can't go and build that day. So the skyscraper doesn't go any higher, but it also doesn't go any lower, right? It doesn't, all of your progress doesn't go away just because it rained. You just didn't make any progress that week, we'll say. Say it rained a whole week and you couldn't work all week. So that's exactly how these function. So typically they're characterized by having a 0% floor, but then you get to participate in the interest. This is what I have. So when the market goes negative, I'm at 0. I'm just not earning anything. I'm not building that day. But when the market goes up 10%, then I get to participate in some of that gain, right? So when things are good again, I'm building. So there's a ton of like Doug Andrew videos that you can watch. And I believe he did an experiment, or he said that there are analysts that have tested the theory between, variable annuities and equity indexed annuities. And because variable, somebody, you could explain this to somebody, they're like, well, what if I'm capped at 10%, but the market goes up 20? Okay, you might be capped at 10, but your floor is 0. With a variable, you're going to go up 20, but you could go down 15. Does that make sense? So he's got videos that you can watch where over a long period of time, they'll study what does better. And typically these will do a little bit better because they're not participating in any of that loss. We can never really, we can't control what the markets do, but we can sometimes be like, oh, that's not so good. Or economically, we're not in such a great place that we think, things are going to start looking down. But there's nothing really that you can do about it if your money's in a variable. But this helps to protect what you've already made and let you participate in the good times, but not the bad. So I like it. I have 2 of these. They're pretty great if you learn how to explain them to people and sell them. I think the skyscraper analogy is like pretty simple. That's what I rolled my 401k into. Okay. 403B plan. This is a tax sheltered annuity plan reserved for nonprofit organizations and their employees. So this is going to be educational organizations, nonprofit charitable organizations, and religious organizations. So like my mom is a teacher, so she has a 403B. Okay. Exclusion ratio. This is the method of determining which part of an annuity payment is taxable and which part represents the tax-free return of the annuitant's after-tax cost basis. So I think I briefly touched on this with you guys before. Let's say there's $600,000 in my annuity when I roll my 401k into it. So that would be, we'll call that my cost basis. Bear with me. So we're going to just say that I start an annuity throw a lump sum payment in there of 600,000. That's my cost basis. Those are my after-tax dollars. We'll just go there, right? And then as you make interest over time, let's say I throw that 600,000 in an annuity when I'm 45, and I don't start taking distributions until I'm 65. So for 20 years, I'm getting interest. So the exclusion ratio is the math equation that they're going to use to figure out, okay, once I start to annuitize, and I'm in that annuitization phase, and I want to take benefit payments, how much of this benefit payment are we going to say is cost basis, and how much are we going to say is interest that I made that I now have to pay tax on? That's all that means, because it's going to be not 50-50, but if your money sits and you earn interest, part of that you have to pay tax on. You have to pay income tax on your interest gained. So this is how they figure out how much you don't owe taxes on and how much you do. Straight life income annuities pays the annuitant a guaranteed income for the annuitant's lifetime. When the annuitant dies, no further payments are made to anyone. If the annuitant dies before the annuity fund is depleted, the balance is forfeited to the insurer. So we talked about that, right? So a life annuity with period certain option is just this, but with that, okay, 10-year period certain, I die at year 6, my family gets it for 4 more years. Straight life income annuities, that's it. It's my life. When I pass, so I could take one payment on a $600,000 annuity and pass away. Nothing goes to my family. It goes back to the insurance company. So things to be aware of. Okay, sorry, this is like new. Quizlet doing ads is like not anything I'm used to. Period certain option, guaranteed payments for a certain period of time. If the annuitant dies before the period has expired, the policy pays the beneficiary through the remainder of the period. Essentially the same thing we've talked about. Okay, market value adjustment. This is an interest rate adjustment based on whether the current rate of interest is higher or lower than the rate in which the annuity was guaranteed. So this is just an adjustment. It's a way for the company to shift some of the investment risk to the owner, essentially. So if it's almost like equate, that's the word. I will equate it to like mortgages, right? So if you buy your house in 2020 and it's a 3% interest rate, but then you go and something changes and you like add a person onto your title or something and ownership changes, of course your mortgage company is going to go, something changed. Like, nope, you don't get to keep your 3%. Like, you're at modern day interest rate times, you're at 7% now. We're calling that loan back. It's kind of like that, just, interest rates are going to shift over time. And this is for the company to say, hey, like, we can't eat all of this. Like, I have to shift some of that risk onto you. It's just your interest rate will adjust due to interest rate environment. I hope that was helpful. I don't know. That one I struggled with. I had to look that one up. That one's on my cheat sheet. I've never really been so good at explaining market value adjustment, but it's not necessarily something that you're going to come across all the time. Definition of annuity: systematic liquidation of a sum of money over a period of time. That's all it means. I take this $600,000 in this annuity account and I take a little bit over time, right? I want to make sure that I have a steady income stream. That's what an annuity is. Steady income stream, systematic liquidation of a sum of money over a period of time. Surrender charge is a fee charged to the insured when a life insurance policy or annuity is surrendered for its cash value. A lot of time there's like a period that you'll have a surrender charge of like 10 years or so, and then afterwards it'll go away. So this is just again, like a way for the company to protect itself if you cancel the contract in the early years. Annuitization phase. See, I told you, it's kind of like all out of order. So like we talked about the accumulation phase a long time ago, and I gave you the definition of annuitization phase, and now we're back to it. So this is the point at which the annuity begins to generate benefit payments at regular intervals. Accumulate, 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 and then we annuitize and we start to pay out at regular intervals. Pretty self-explanatory. Cost basis, I think I just used this term. This is the amount of money paid into the annuity. So that's like your premium, after-tax dollars. And then, of course, interest on top of that. Cost basis, you don't pay taxes on. Interest, you do. Deferred annuities accumulate interest earnings on a tax-deferred basis, right? You don't pay taxes while you're accumulating. You pay taxes after you start taking payments. Oh, yeah, there you go. Okay, no taxes are imposed on the annuity during the accumulation phase. Taxes are imposed when the contract begins to pay its benefits. You'll pay income tax on the interest part, not on the cost basis part, once you start taking payments. Two types of Social Security insured. This is supposed to say statuses, not statues. Fully insured and currently insured. This isn't necessarily like an explanation one. It's just like, just memorize fully and currently. Two types of Social Security insured statuses. Okay, your fully insured status. This worker must accrue 40 quarters of credit, which is equal to 10 years of work. That counts. So 40 quarters of credit counts as fully insured. Currently insured is 6 credits during the last 13 quarter period. You will see examples of how these questions will be asked in, I want to say, like part 1 of my 8-part series. So again, it's super straightforward. It's not like an explanation one. It's kind of just like, it's memorization. Social Security statuses, fully and currently. Fully is 40 quarters of credit. Currently is 6 quarters of credits during the last 13 quarter period. Social Security survivors benefits. Pay a lump sum death benefit or monthly income to survivors of deceased covered workers. The surviving spouse without dependent children is eligible for survivor benefits as early as age 60. There's a blackout period. We're going to get to that at some point, but if you are not 60, it's not automatic that you will get survivor benefits. Keep that in mind. So this is who the benefits are available to, because like I said, it's not automatic. So this is who is available for those survivorship benefits. A spouse of any age who is caring for children under the age of 16. So if you have like an age gap relationship, I looked it up, the Social Security benefit age, it said is 62. So let's say your spouse is 65 and they're getting Social Security, but you are only 55 and you're not at that age range yet. If you are 55, but you have children under the age of 16 that you're caring for, you're eligible. Your children, the children themselves, if they're under 18, the children themselves, if they're under 19, but they're a full-time student, and children at any age, if the child themselves are disabled before age 22, and if they're still disabled at any age. So that's who those survivorship benefits are available to, other than somebody of age, which would be 60, right? As early as 60. Social Security disability benefits are only available prior to age 65 if the worker meets the restrictive total disability definition under Social Security. And I think that's next. Okay. Disability definition is the inability to engage in any gainful activity by reason of any medically determinable physical or mental impairment, which has lasted or could last for at least 12 months, or result in death. So you have to have some sort of condition that keeps you from being able to produce an income for yourself in order to be considered disabled by Social Security's definition to receive those benefits. I hope y'all are tracking. You are more than welcome to slow me down, or you can rewind. I hope all that was clear. I know I'm like going a little bit faster, I feel like, but I feel ready this time, so I'm happy about that. Okay, I mentioned the blackout period. This refers to benefits paid to the surviving spouse of a deceased person who was receiving Social Security. The blackout period begins when Social Security survivorship benefits cease. This is when the youngest child turns 16 years old, or if there's no children immediately. So if you're 55 and you have no kids, but your spouse was 65 and they were receiving Social Security, blackout period. You're not old enough yet, and you don't have something that qualifies you because you don't have children. The blackout period ends when the surviving spouse turns at least 60 years old. So if you're the person that's 55 in my example, your blackout period is 5 years until you turn 60. Okay. Retirement plans. How fun. Qualified retirement plans are retirement plans that meet certain federal requirements and therefore qualify for special tax treatments. 5 requirements. Plans must be for the exclusive benefit of employees, in writing, a written contract, non-discriminatory, either defined benefits or defined contributions, and permanent. So some examples of your qualified plans are your 401ks, your 403bs, your simple IRAs, and your SEP IRAs, all qualify as qualified retirement plans. A non-qualified retirement plan is a retirement plan that does not meet those 5 requirements established by the IRC for favorable tax treatment. So examples would be deferred compensation plans or individual retirement accounts, like your traditional or your Roth IRA. I hope that was helpful. And you can look that stuff up. That was just a very broad overview, but I think it's helpful. Okay, your human life value approach calculates the amount of money a person is expected to earn over his lifetime to determine the face amount of life insurance needed, thereby placing a dollar value on the life of the individual. You would be so surprised to find out how many people you sit with and you do whatever your company's needs approach is with them. And you say, okay, how much money do you make a year? They say 70 grand. You do all the math. You do all the calculations. They're like, okay, your life insurance need is 1.5 million. And they're like, what? I don't need 1.5 million. Your income stops when you stop, if you have a job, right? Your income stops when you stop working for it. So your family that's used to having $70,000 a year no longer has that $70,000 a year if you are not here to create it for them, right? So that's where you have to sit down and help somebody determine what is the value of your life based on the income that you're bringing in to support your family. And how do we make sure that your family will still have that income even when you're not here? So that's your human life value approach. And the needs approach is a method of determining how much life insurance you need based on funds your family would require to maintain their lifestyle after your death. We use DIME in my company, debt, income, mortgage, and education expenses. So that's how we would sit down and do your needs analysis. Okay, we think you need 1.5 million because you have, 3 kids and school for them is going to be 150,000 each. And then you've got this mortgage, a little bit of debt. We want to make sure it gets paid off. And that's you sitting down and doing a needs approach evaluation with a client. What is your family going to need if you're no longer here to sustain their life and to pay debts? Okay, so that was your individual. life insurance need analysis. This is business continuation plan. Arrangement among business partners or owners that provides for the continuation of the business in the event of death or disability of one of the owners. Business continuation plan. Okay, come on. Okay, how do we do that? We can use key person insurance. This is life insurance that protects a firm against losses due to the death of a key employee. Like I mentioned before, CFO, CEO, COO, all the above, or any other key employees have a lot of intellectual property. You know, they play a very integral part in a business. There's going to be loss if that person passes away, loss of time, loss of productivity. You have to spend the time to find the right person. That person has to get trained up and has to essentially figure out all of the stuff that the person that passed away like had in their head. So yeah, that takes time, that takes money. So this is life insurance that a business can purchase on a key employee to ensure that they have the money to continue in the event of the death of that person. This probably should have been first, but like I said, they're not in any like super particular order. So the different types of business continuation plans, you have key person insurance, which we just talked about, a cross purchase agreement or a stock redemption plan. Okay, deferred compensation plan. This is not part of business continuation planning. This is an executive benefit that an employer can use to pay a highly paid employee at a later date, such as upon disability, retirement, or death. So we have clients that own a business and I think they just had their 20th anniversary party and they have an employee that's been with them from the beginning. She's helped to build this business. So the owner said she wanted to take care of this woman that helped her to build the business from the ground up. So she's using a deferred compensation plan to essentially give her a retirement above and beyond whatever her 401k is. Okay. Salary continuation plan works the same as deferred compensation, except that the employer funds the plan rather than the employee. The employer establishes an agreement whereby an employee will continue to receive income payments upon death, disability, or retirement. I may have said all that wrong. I think that's fine. I think you guys understand. Deferred compensation, paying a highly paid employee at a later date, salary continuation. This would be probably more like what our client is doing for her employee, making sure that she has a retirement, even though she called it deferred comp. I hope I don't confuse you guys. Really am trying. Split dollar plan, funding mechanism whereby employer and employee share the cost of the premium. The plan typically allows the employee to choose the beneficiary. So that's good. They're sharing costs, but the employee has the benefit of saying, I want my spouse to be my beneficiary. So that is a split dollar plan. Okay. When you guys make it to the 8-part series and you start going through questions that could be on the test, you'll see, what does ESOP stand for? This is your answer right here. Employee Stock Ownership Plan. Employee owner programs that provide a company's workforce with an ownership interest in the company. A lot of times business owners will say, you know, when you have an employee that has done quite a bit, has been with you for a while, has been loyal, and has helped you to build your company, they'll say, I want to offer this person a piece of equity. And so this is one way in which you can do it, is offering them an ownership interest through an ESOP. 401k, if I had my way, this would have been next to 403Bs, but this is another qualified retirement plan. It's a retirement plan that allows employees to defer receiving some of their compensation until retirement, with contributions to the plan taken out of the employee's paycheck pre-tax and the funds accumulating tax-free until retirement begins. This is pretty self-explanatory. Y'all should probably know how 401ks work at this point. You take a piece of your paycheck, put it into a 401k. It grows in this 401k with the market. A lot of times your employers will match, and you don't pay any taxes until you start taking it out in retirement. So it grows tax deferred. You pay income tax when you take payments from it. PO plans. This is another example of a qualified retirement plan. It's designed for unincorporated businesses that allow the business owner to participate as an employee. So simplified employee pension. We also call them like self-employed pension. Tax deferred account to which the self-employed and employees of very small businesses can contribute. This is another example of a qualified retirement plan. Yeah, we call them SEP-IRAs. Self-employed pensions. Simple plans. Savings incentive match plans for employees. This is for businesses with less than 100 employees who earned a minimum of $5,000 in compensation. Simple IRAs are also examples of qualified plans. Traditional IRAs, individual retirement account, a personal qualified retirement account through which eligible individuals accumulate tax-deferred income up to a certain amount each year, depending on the person's tax bracket. Tax-deductible contributions, but taxable distributions. So even though this is a non-qualified retirement plan, it functions a lot like a 401k in the sense that you can deduct your contributions to your traditional IRA in that tax year. So I put in $25,000, I can deduct $25,000 from my income, tax deductible contributions, but taxable distributions. So when I go to retire, when I'm 65, and I go to pull that money out, I will be taxed on those distributions, and that will be income taxes. That's your traditional IRA. Okay, RMDs, or required minimum distributions. So you cannot, in a retirement account, you're putting money into it, but you can't touch it. You can't take it back out without penalty until you are 59 and a half years old. Can't touch it until then. But what if you say, well, what if I don't want to retire at 59 and a half and I am a young buck, I'm a spring chicken, I want to keep working. Maybe I don't want to take anything, until I'm much later. I want to work another 20 years. You can't take the money out until you're 59 and a half, but the government says, I want my taxes, so I'm going to impose an age on which you have to start taking money out. This is where your RMDs come in, your required minimum distributions. Traditional IRA owners must begin to receive payments from their accounts no later than April 1st, following the year in which they reach age 70 and a half. I looked this up today because things change all the time, laws change. And it said RMD age now, like 2023, is 72. So it says it's no longer 70 and a half. So just be aware of that when you are dealing with clients and you're letting them know, yeah, you can accumulate for a long time. You can't say as long as you want because you have to explain RMDs to them. Yes, you don't have to start taking anything out at 59 and a half. You can leave it in there for another 10, 11 years, but the government does say you have to start taking money out at age 72 because they want their taxes, right? Okay, a Roth IRA. This is a personal retirement savings plan. It's non-qualified. Contributions are not tax deductible, but earnings are tax-free. So it's the opposite to a traditional IRA and a 401k, right? Opposite. Contributions are not tax deductible. So you have a limit of what you're able to put into your Roth IRA every year. And I looked this up too, because I wanted to make sure that all you guys were read into all of this. And whatever year you're watching this, you have to look it up because it changes every year. So for 2023, if you're under 50, your contribution maximum is $6,500. If you're 50 or over, it's $7,500. But come 2024, come a month from now, because it's December 1st as I film this, for 24, if you're under 50, your new maximum contribution is $7,000. And if you're 50 or over, it's $8,000. So it will change every single year. You have to make sure that you are up to date so that you can explain this to clients if, for some reason you have to, and you're going through this with them. So they can contribute, I'll use today's numbers, up to $6,500 a year. You cannot deduct that $6,500 a year from what you owe the IRS in taxes in that year. However, when you start to pull the money out, tax-free. So you pay taxes when it goes in, right? You're paying taxes on that $6,500. But if that $6,500 grows to $100,000, you don't have to pay taxes when it comes out. So that's pretty cool, right? And Section 529, guys, I think we're at the end. This is it. It says 144 out of 144. We made it. A qualified savings plan that provides a way to save in a tax-favored way for a child's college education. It's a 529. There are two forms of Section 529 plans. One is a prepaid tuition plan. This is a state-sponsored plan set up to prepay a child's education. This requires a minimum level of funding. The second way is a college savings plan that takes the form of a state-managed investment account into which parents or grandparents can contribute and has no minimum funding requirement. So 529s are great, but they are for education specifically. So I have my little brother's friend whose parents set him up with a 529, and then he ended up not going to college. He ended up going the trade route. So that's where you as a life insurance agent get the opportunity to educate your clients and say, yes, well, 529s are great, and we would never tell you not to do one. Funding a cash value life insurance policy for your child is a really great alternative if you don't have the means to do both, because you're not limited to paying for education. With a cash value life insurance policy for your children, you can have living benefits. That cash can be used for college. It can be used for a first car. It can be used for a first house down payment. You're not as restricted to what you're able to do. It gives you a lot more flexibility. So educate yourselves a little bit more on that. Hopefully that was a nice little first taste of, hey, you can talk to them about this as well. Okay, I think that will do it. Let's hit it just to make sure. And we're done. Okay, guys, thank you so much for being patient with me. I really appreciate it. I appreciate all of your comments. If you haven't already, subscribe. I'll probably continue to put out content. I do have 2 more videos to put out after this one. I don't know if they'll go out tonight. They'll go out sometime this weekend, though. It is my absolute, not goal, but I don't have a choice to get all 3 that I've promised you guys out this weekend. Yeah, comment what state you're in when you're taking your test. Come back and let us know if you pass, and share this with anyone else on your team, in your company, anybody else that you know is going to be taking this exam. Let them know that this is their one-stop shop. Go through my 8-part series. Video number 8 has a little test taking tip to help alleviate test taking anxiety if you do get anxious when you test. And yeah, just keep coming back for more until you guys pass. Thank you so very much.